Good evening, traders and investors. It is Monday evening, September 29th. Let's recap on what's unfolding in the markets and cover what some subscribers want to see or cover or touch on here on the markets. Now, overall, equities had a nice positive day. They did open higher this morning. We talked about how the market was set to gap higher, and I said, don't be alarmed if price fades back down to fill the price gap. And that is a healthy type of price action. So what we saw last week, if we try to just live vicariously through the price action and what the majority of traders feel, the market had a gap down. We saw panic selling. The market got oversold on this session, and then we saw a rebound. And usually from an oversold, it gets bought up. And we saw on Friday the market rallied up, pulled back, filled the price gap because it did gap higher. And then it closed fairly strong on the session. Now that excitement carries over the weekend. In fact, it builds over the weekend. It's actually exactly how we timed this giant move here. If we go to this market, we talked about how this close on a Friday was going to create a huge gap lower on a Monday, flush out, and then put in this giant rally that we have seen. We called that play really to the day, on the Friday, and it unfolded, and we're still in that rally. So going back to the 30-minute chart, everyone panicked out. Whoever was going to panicked out on this session. And then we had a strong close. The market closed positive for the weekend. And of course, everybody was very strong over the weekend, and they want to buy today at the open because the market looks like it put in that move. So the market actually is an emotional open today, which I touched on this morning. And that's just crowded players who are chasing and jumping in. And of course, the market is very efficient. If there's a really easy play, it's going to make you pay a premium for it. And then, of course, it's going to fade back down and try and shake you out through the day before going higher. Now, this price action does form a nice move up. We do have a nice little bull flag pattern here, and it is pointing to higher pricing. If we go back and we look, use Fibonacci extension, and we grab this low, we grab this high, we grab this low. This points to where we could see the index run over the next few trading sessions. It's not massive, but it's about 1.4% to the upside, which would push us to all-time highs. And as we know, the market goes from one emotional extreme to the other. We had FOMO here last week, which we talked about. And then we went to panic selling and our oversold condition, a little bit of panic selling and exhaustion gap down. And now we're kind of midway and building a rally here for the market to push higher. So overall, markets are unfolding as we expect. We watch the school of fish where market participants go from greed to getting shaken out to these tiny little moves where, people play the gap higher, they buy in, and then it sells off and they start to panic. And then eventually the market will go higher without them. These are all different scale moves on different time frames, but they definitely really mess with people. Now today we saw bonds post a nice rally here, a big pop to the upside. We'll see how that plays out. Again, this morning, bonds, when you zoom out, are still in a downtrend and trying to find a bottom, so I'm not too excited there. Some interesting things I do want to cover today, though. We did have gold move higher. We had physical gold move up about 1.75%. So we got a nice move up here. We are long gold with one of our positions here. We've got a nice move in gold. We still have the next target still substantially higher, around 30.71 from this move. So we're continuing to ride this. We've already locked in gains at our first target here at the golden ratio. And now it's working its way up to the 100% measured move. It's about 8.5% upside move in gold. This is the Sprott Money Gold, but it's the same if you look at GLD. It's another physical gold fund, or if we just look at gold futures themselves, it's the same move no matter what that needs to unfold. Just the ETFs are the easy way to get in and out of physical gold versus buying a bar and then hawking it, for a premium. When you buy and sell physical gold, it can add up versus just a quick trade in an ETF. So some of you want to talk about gasoline. I have not looked at gasoline, I feel like, in years. The futures chart for gasoline, if this is the one that you guys look at, it's the only one on TradingView. In the grand scheme of things, when we look at this chart here, you can see it looks like it's breaking down. Looks like it wants to go lower. It is dipping down into these lows that we found before. Long-term wise, it's in a downtrend, but it is at some long-term resistance. So it's not the cleanest looking chart. If we look at it from a monthly standpoint, you can see here, I'll just zoom in a little bit. From a monthly standpoint, it had a COVID low, it's rallied up and it's fading down. It does look like this could unwind, and we could see gasoline actually drop quite dramatically in the long run. It does need to break through the support level about 186, somewhere in here. If it breaks that, we could start to see it head down to about 130. Just visually, that looks like 130 is this cluster high right here. It's this pivot low. There's another pivot low here. There's a pivot high here, a pivot low. So that would be the next kind of level to the downside. But in the grand scheme of things, go to the daily chart and we zoom way out. It's not the best looking pattern at this point, but a breakdown below this 186, 184 area could trigger a pretty decent run to the downside. If we take a look at that from a ETF standpoint, UGA is an ETF that one of you mentioned you wanted to see. I'm just going to zoom out so we can get a bigger picture of this. So this is the COVID low. It's run up. It's been holding its ground. Now, I don't know how this is built. Typically, these type of funds are not I don't think this is an ETF. I think it's ET. There's another name for them. I can't remember anymore. But anyway, I'm not sure how it's built. I don't really trust some of the commodity ETFs in the energy space, but it has been moving up. It's funny. It's moving higher, even though gasoline's been going down. So I don't know how this thing is built or what they're basing it on. So if gasoline breaks down, we could potentially see this break down as well, and it could unwind in a pretty big way. Maybe this is similar to a gasoline stock fund. Now, I haven't put any research into this. If this is based on stocks, this may make pretty good sense. It could be almost like the energy play we're looking for, that eventually we'll see the energy sector stocks have a huge waterfall, swan dive here. Another sector here was healthcare. And one of you talked about how healthcare typically acts as a defensive play, and I talk about that as well. It can be seen as a short-term defensive play, and you mentioned how it's been going sideways more or less for a few years, and it's pretty noisy. The stock market, it's been underperforming and going down. I think there's a lot at play here. Now, this is a pretty ugly chart. It's been going sideways. I don't like stuff that has this big chatter, a lot of back and forth here. It's not ideal in terms of for trading. So I usually steer clear of a lot of stuff that's kind of naturally noisy. That's why I love the stock indices. They're more of like a nice big smooth wave, and we can filter out the noise and we can play the bigger waves and gauge which ones have a lot of momentum behind them. But I think the healthcare space may really have a lot of headroom, because you look here in 2022, and this is kind of when the drug pricing reform kicked in, I think it was the Inflation Reduction Act, and that was like it gave Medicare buying power. They can negotiate pricing, and I think that completely threw the healthcare sector out of whack. I think there was also like all kinds of other regulatory stuff. So I think the healthcare sector now is kind of in no man's land, trying to figure out how it functions and all that stuff. So I'm not a big fan of this space either at this point. Also, we had another member wanting to know about, instead of going just SPY, QQQ type for our ACS strategy, wondering about if we could get into emerging markets, Latin America, China, or India, and play some different ETFs. He pulled up here KWEB, which is the China ETF, or one of the China ETFs. You can see it's gone through this big phase. It's fallen out of favor. It looks actually very similar to the bond chart and what bonds could do, eventually come to life and start to move higher. But the reason I don't get into these international funds is because they're generally fairly noisy, and I really like to trade what I can gauge and understand and trade successfully and invest in. So the US markets to me are the cleanest. I understand them. There's the same data. There's cycles at play. There's a lot that have gone in. And as we've talked about before, if you know what the US markets are doing, then you can use that as your gauge to potentially get into some of these other types of trades, these discretionary trades on the side, if they give you a proper trade setup going forward. So again, I don't want to be a master of all. I'd rather be really good at a handful of things and do that than try reaching into other pockets in other country ETFs that have different policies at play and different cycles. And, every culture thinks and trades and does things quite differently. And so I don't really want to get into other things that I don't know. So I always stick with the US markets. They were talking about how, in terms of the euro, even though the like SPY and the NASDAQ have gone up, based on the price of the share, the change in their currency from the euro has made it relatively flat. And this is the number one issue, I think, with international traders is if you buy US equities and the US dollar goes down in value, then it can counter that. Now, I do think the US dollar is getting closer to a major bottom and starting a significant run. So I do think there'll be a benefit there at some point. But overall, you'll have to play a lever or a hedged ETF, meaning you buy an SPY ETF in your country that is hedged against currency. Canada has these. So you're really just playing the price action of the index. It doesn't matter what a currency does. We're just playing the up or down movement in the ETF, and it negates that. That's kind of the only way around it. And I don't really want to jump to international ETFs in terms of trading different countries, simply because the tools and the data available to track money flows in the US and US equities and things, that is gold. Like, we don't have that in these other countries. And so we get to like more or less see the market's hand and play a game of cards with them, and we know what their hand has, and it's just we follow their lead on what they're doing. And again, if you like the analysis of the 30-minute chart to know when the market has got FOMO, when it has, panic selling and the markets are dipping into, oversold territories and all of this stuff, all of that, just as a reminder, because so many of you keep saying you want to create the same charts, is in my book, Technical Trading Mastery. If you go to Amazon and get this book. Now, if you have bought the Kindle in the past, and this is actually a good thing going forward, this is what a member shared the other day. If you buy the Kindle version, then you can access this. And when we do minor updates to the book, because we just did the update and added these indicators in and the instructions on how to set them, then whenever we do an update in the book, instead of having to rebuy the book, you can just delete the Kindle version in your Kindle account and re-download it, and you get the new version. So you can do it either way there going forward. But Technical Trading Mastery, this has got how to create the FOMO indicator, the panic selling indicator, the oversold and overbought indicator, how to identify trends just using the 5 and 20-day moving average, which is really, really simple, which you could color code the bars if you want to be green or red, depending on the trend, to know if you should be focusing on FOMO or panic selling for a trend. For example, when you're in an uptrend, like we are now, you don't really care about FOMO. We just know there might be a pause or pullback, which is fine. The key here when you're in an uptrend is when the markets get oversold and have panic selling, it can be a spot, if you're an aggressive trader, to add to a position and play these impulse moves to the upside that usually last 1 to 3 days going forward. So anyways, that's it for now. Take care. Bye-bye.